Oh, man. Travis Avila. We are here with Harry Bennett. What a beautiful day on the Central Coast. Harry has become one of my top favorite people on the Central Coast. He does the majority of the loans for our clients.
Thank you.
He has done a fantastic job, works his tail off. I've never met anyone that works so hard. Over the weekend, working lenders. I mean, this guy's nuts. No lenders.
24/7.
24/7.
Doesn't stop, man.
Doesn't stop. Hey, has a wonderful family, and just high value, high character, great guy.
Thank you.
So
Jeff.
here we go.
Well,
Man,
we're blessed to be around you guys, man.
We're gushing, dude.
We're
I
gushing.
know. They accuse me of that sometimes with certain people, and that's one. You're one of them when I'm talking about you. They're like, you're gushing so much.
Okay, so we brought you in, Mr. Harry, to talk about assumable loans because I don't know if you know this, but interest rates are a little uncomfortable for people.
They're a little high.
High. They're not, but they are.
People feel a pinch for sure.
Yeah. So it definitely hinders affordability a little bit, these higher interest rates. And so maybe we talk about, let's start with like what is an assumable loan and how is it different from like a regular loan program?
Yeah, so the assumable loan is what it sounds like. You're going to assume the seller's current loan.
You can do that?
What?
You can do that. You could do that. So an assumable loan is that you're going to take the original terms, the interest rate that the seller currently has with the current lender, and then the buyer is going to assume that loan with the original terms. They're going to take that over, and that includes that lower interest rate.
Is this what they talk about all over YouTube called subject to?
No.
Ah, good.
Oh, that was a test.
Yeah, no. Subject to loans are different. That's where the seller is going to be remained on the loan, and then the buyer is going to go ahead and pay the payment on the behalf of the seller, but the seller is still obligated for the loan.
Yeah.
Okay, so is any loan assumable?
No.
Ding, ding, ding.
Only government loans.
Give us examples.
FHA, USDA, and VA loans are all assumable, but not conventional.
Not conventional.
Correct.
We were just
Which
talking
is good because there's less down payment on those loans, so maybe they're higher balances.
Yeah, because you're only putting like a 3.5% down or something like that on.
Which really, if you're assuming a loan, you need as much balance as possible.
Well, and we should be clear, like this is the benefit of an assumable loan is if it's, a higher balance maybe on the loan with a very low interest rate.
Correct. Yeah, you're going to want, like, the ideal assumable loan is
a 2022 loan.
Pretty much. If I was to assume someone's loan today, what I would look at is a loan that has a higher loan to value on that home. So someone who ideally purchased in 2022, maybe 2021, but now there's a difference between what the loan is, like where it's currently at, and then the value of the home of what the agents are going to negotiate, right?
Yeah. So what do you do if you can't make up the difference?
If you can't make up the difference with cash,
we're going quick. Let's slow down just a second. Sorry. Okay, I just want to make sure we're not losing people. So what we're describing is, let's say that there's a home that's on the market and it's listed at $800,000. It's like, well, how do you know that it has an assumable loan?
Where's that house?
The house.
When my clients get interested.
This is not a real home. They don't exist. 800,000. No. How do you know if it has an assumable loan? Call Jeff or I.
You're going to get with an agent. You're going to get with you guys first. Yeah. Get with
specifically.
Travis.
Yeah.
Get with Travis
okay.
and Jeff.
So let's say like $800,000 home, and it has an FHA loan that's has $500,000 at a 3% interest rate. That's going to save you a ton of money. So you assume the $500,000 loan at whatever interest rate it is,
and whatever the term is left.
The terms left, and then you have Jeff saying, but you have $300,000 still. What do you do?
Yeah, you have that gap there.
Yeah.
So you're going to offer 500. No,
you offer 500, and they laugh, and then it's over.
No, that's horrible. So you do have that gap there, and what you want to do is you're going to have to either come in with that cash, that $300,000 cash, which is going to be tough for a lot of folks. But if they are in a position to do that, that's ideal, right? Because then they get that $500,000 loan with a 3% interest rate. Maybe they got inheritance for that $300,000. There you go, right? Or they sell a home and then now they can get that, right? The second way is they can actually get a second mortgage to help cover the gap. However, when they get a second mortgage, always with second mortgages, there's going to be a good premium on that interest rate. So you're not looking at, like, say, today's rate, you're looking at the high sixes, low sevens type of an area. With a second, you're going to have that premium based off of the risk, right? They're second in line to get paid. So you're probably going to be looking in the mid 8s to maybe 10s to get that second mortgage. So you have a blended rate there.
And so you have to just kind of work through the scenario.
You're going to have to work
with your realtor lender partners to figure out what makes sense.
Yeah. Third option.
Oh.
Seller says, hey, I'm going to let you assume this loan and carry back.
Yeah.
But it's we've done one this year like that. It's hard to get.
What is a seller carry, Jeff?
Seller carry is basically the seller acts as a bank because they've already paid down the loan by that $300,000. They have the equity in the house, and they can say, okay, well, I'm gonna have a note on the property. I'm not gonna actually get any money out of this, maybe some small down payment or something. And then they get to carry the paper, carry the note, and move forward getting a payment, which is nice sometimes because if they owned it less than 2 years, then they can defer the capital gains over a longer period of time.
Which could be smart. Yeah.
Which could be smart.
Yeah.
Or if they just did, like if they've sold the house recently and got the capital gains off of that, like let's say they had a different house for 3 years or 2 years out of the last 5 years, and they used that and sold that, pulled the full capital gains out of that tax-free, right? Then they can't do that again with another house. So within that 5-year period. So they could do this to alleviate some of the capital gains.
And that's exactly why you have agents like you guys that know the intricacies and
of
a transaction.
Here's the thing. Thank you, Harry. You're sweet. But here's the thing. We, with assumable loans even, we're not saying that this is a silver bullet or it's always going to work or whatever.
Most sellers are like, huh?
To get into that, it can be a little bit tricky. But my point and our point is that there is no perfect market. There's just the market that you're in. And I think the thing that we are so passionate about is educating people on, you've got to have a strategy for the market that you're in. I don't know and so if you're going to wait, fine, but understand the risks and rewards of waiting. And I can't tell you what that market's going to be. I have no idea.
I could tell you that historically it's going to be higher.
Yeah, we can look at history and say it's very likely that you're going to pay more.
And interest rates are like at the 50-year average. So
yeah. And who knows what'll happen? I'm just saying these kinds of conversations are so important because at least now you know more and you have options that maybe you didn't know, and you might still decide that it's not the right time to buy and whatever, that's fine. But I love these kinds of conversations because most people probably don't know that this is even an option.
No, exactly. Yeah. A lot of people do not know about this as an option. And then secondly, it's just getting more creative with finance. It's really what it is. It's being creative, it's trying to make something, trying to fit the round peg into a square hole, right? Or vice versa. So it's a way to get the home today that's more affordable if all the stars can align or you can ask the right questions.
Yep. Okay. Back to, sorry for my TED talk there, but I really am passionate about that kind of thing.
What about can we shift a little bit to buying down interest rates? I know that we're talking about assumables, but using maybe some other techniques to buy down the interest rate. So, let's say the seller's like, hey, I can't quite do the assumable thing. That it's a conventional, so I need to be able to just sell it and, all that. Yeah. What's some other ways to help out with the interest rate, bringing down the monthly payment?
So if you're you're talking about in the eyes of a seller to induce, to help.
Yeah, help induce interest or even like for both parties to win.
Yeah. So there's two ways to basically manipulate the interest rate and get a more affordable payment. So option one is called doing a permanent rate buy down. And so permanent rate just sounds just as it is. You're going to take today's standard rate, let's say if it's at 7%, and you now are going to buy the interest rate down to maybe say 6.5 or 6.25 rate for the rest of the term, 30-year fixed. You can definitely negotiate that with the seller, and maybe the seller can help contribute if it's if the seller feels like to help incentivize a buyer to buy that home and create it more affordable. It also not only just creates more affordability, but it also creates more buyers for that house, right? So if you have a seller that's considering putting out there a permanent rate buy down program, right? That they talk to you guys, say how much is this going to cost? You say, hey, this is what we can do. they get with a lender like me, and we can do those rough numbers, but that will actually help qualify the buyer, right? Because the buyers they're qualified to a certain point in a payment is what it comes down to, is what's your max payment. And then so the buyers are qualified. So if they drop the interest rate, they're actually going to create more pool of buyers, which could be more competitive for them when they actually sell that home. So that's first way, is permanent rate.
I love that.
Second way is what's called a temporary buy down. And then that is strictly, most of those programs are paid for by the seller, and they can do what's called a 2-1 buy down. That's the most popular program. There's a 3-2-1, a 2-1, and a 1-1-0. And you're probably thinking, what the heck does a 2-1 buy down mean? So a 2-1 buy down, let's just say that the buyer starts with a starting rate. The note rate is at 7%. The seller will actually contribute some money, and it goes into a little escrow account. It's a little side account there, right? Once the transaction.
It's a little account. It's like this little tiny.
It's like a little. It's got
very
like
few digits.
30 grand, 20 grand in there. And so what happens is that the buyer, their note agreement to the lender is going to be at 7%. They must also qualify at that payment to not make it a toxic loan, right?
Smart.
We don't want to put people in a bad situation.
Yeah.
So what's going to happen is that note rate signed at 7%. The first year on a 2-1 buy down, the 2 represents taking off 2% off that interest rate.
What?
So the first year, it's going to feel like those first 12 payments are going to feel like that payment is actually at a 5% interest rate versus a 7% interest rate. Okay. And then the 1 in the 2-1, the 1 represents taking off 1% off the interest rate on the second year. So starting payment 13, their payment's going to go up a little bit to now mimic a 6% interest rate. And it'll be like that until
I'll tell you why this is so good. So this works great for people who are like, hey, we know we're gonna have income going up. We want to get into a house right now because we want to secure our housing future. And so it could be someone like who's, maybe they're in a tech job or something like that, and they know that they're going to get the annual bump. Yep. They know their company's doing really solid. They're not worried about it going bye-bye. Yeah. It's the perfect thing for them, right? Or maybe it's like someone who has kids, and all of a sudden those kids are going to go to school, and there's going to be a new second income coming in to make up that difference, but it's like 2 years off. So they need a little gap, just a little stopgap to help get them to that time period. It works so well for those situations where your income's going to be going up, you'll be able to afford it. Or if maybe there's some kind of change where you're going to have less expenses. So like, hey, we know we're here right now, but in 2 years we're going to be paying off this medical debt, or we're going to be paying off the car or whatever it is. And so this works well in that type of situation as well.
That would be perfect.
Paying off debt or an increase in income.
So a couple questions that people might be wondering here. If the seller's contributing, is it an out-of-pocket cost for them? Where does the money come from for the seller if they're contributing?
It's going to come from the proceeds of the sale.
So so they're not like having to come up with the cash.
No, they're not coming.
It's just coming off the proceeds of the sale.
Correct. Yeah.
So this is all like risk reward, because you're like, well, what the heck? Why wouldn't everyone do this? Like, well, I mean, it could just not be the right program for you. You might not be in one of those situations that Jeff just outlined. But if you're doing a 2-1 buy down, you're kind of betting on the rates are going to come down, and you can ideally refi in the next year or two, right?
Yeah, I guess that's the third option.
Yeah. You could refi.
You could be a savvy buyer.
We've been guessing.
We've been
thinking that the rates are coming down when they haven't.
They haven't yet, but it's as of the recording today, they're talking about maybe one rate cut this year.
Hopefully,
so we'll see. Fingers crossed.
Happens.
But that's kind of you could just let it play out and go know that in a few years you'll be at that 7%, or you could refi at some point along the way and lock in another. And you have to pay for the refi and all that kind of stuff, right?
Here's the great news about that. If you're going to refinance, and let's just say you're into like payment 9 or 10, right?
Yeah.
And then you see like, oh, perfect. Here's my chance to go ahead and lock in a fixed 30-year rate at the current rate.
Yeah.
Then that money that was unused, that's sitting in that escrow account as a subsidiary account for that reduction in payments, that's still your money. You can't cash it out and take like a check. But what you could do is use it to either drop down the principal balance on your current loan or your new loan, or B, you can use it for your closing costs.
I didn't realize you could use. I knew about the principal. I didn't know you could use it for the closing costs on the refi.
Mortgage Wizard.
Mortgage Wizard. That's cool.
That's a great handle for you.
Mortgage Wizard.
The Mortgage Wizard.
Dude, I love that.
That's cool.
I feel like I have to be like another 30 years in the business.
Yeah,
with
you need a beard. You need a longer beard.
With a beard, longer beard.
Yeah.
Okay. Let's go back to Assumable.
He knows the spells, but
the spells aren't the problem. The black magic is not the issue.
it's the beard.
It's the beard. Stupid.
Dude, I love this. Okay, so let's jump. So for buyers, are all, oh, cool, I want Assumable. Like,
yeah.
So the question is for the seller. He's like, well, I got plenty of buyers that could buy without assuming a loan. Why go through the extra headache of making them go through this bank to get approved and blah blah blah? Why the heck would a seller care to do it?
Well, if they currently have a 3.5 interest rate,
yeah,
and they know where the market's at, they have a little bit of a pulse of, hey, interest rates are at 7% today. That's going to be super attractive to any buyer.
You think buyers are gonna, or sellers, buyers might like that?
Heck yeah.
Do you think they might pay more for that house?
It sounds like you're asking rhetorical questions.
Yeah. Yeah. So it's going to make your house even look that more attractive. And then they get with you guys, and then you guys are promoting it out there saying, hey, my buyer has, even a 4% interest rate.
Yeah.
Yeah. You see them on listings.
Yeah.
I mean, it's like Assumable loan. It's like, okay, yeah, I'll pay $25,000 more for that house in purchase price.
People are shopping for the loan that's assumable that the seller is willing to do the work to.
But again, they're only on, FHA, VA, USDA loans are going to be assumable. So if in my opinion, the ideal assumable loan is going to be a purchase that was done in 22.
And a USDA loan, believe it or not, folks, a lot of times used for residential purchases, not just for
correct
orchards and farmland and stuff.
Yeah.
What's the downside for a seller?
The downside for the seller, in my opinion, would be the lag time. So you're not going to go through an originator like myself. You're going to, the buyer anyways, they're going to go through your actual servicer. So they're going to contact the bank and get qualified and go through the steps that could take 60 days.
It's a newer thing.
Yeah.
So like they don't have departments for this.
No, they don't even have the knowledge. A lot of them don't still. It's like I said, it's a newer thing.
Yep.
We've had it for a long time. We haven't had to use it. So there is a gap there of, okay, how do we actually implement this stuff?
Yeah, so it probably will create a longer escrow period.
Absolutely. Yeah.
But
I
think the thing that is cool is in Keller Williams we've done it.
Yeah.
So like we've got the people in Keller Williams that have gone through the process to walk us all through it.
Yeah.
It's possible.
How many deals were closed last year in that?
I am not sure. Albert was talking to us, who's the owner of Keller Williams, and we did a handful for sure. I'm not sure how many were actually verified, like assumed loans, but we can find out.
Well, here's another thing. Isn't it true that, especially for VA, if a seller lets a buyer assume their VA loan, because it's like 70% of sellers are buyers, they need to go and turn around and buy it. They can't use that VA loan again.
Not if the person who's assuming the loan is not a veteran themselves. Yeah, 'cause it's going to hold up their entitlement.
It holds up their entitlement. The thing is, though, with veterans that are savvy and they know they want to get the top dollar, a lot of times when they're selling their home, they go, oh, I could easily go into the 20+% conventional financing, which is maybe a little bit more expensive, but typically not, right?
More expensive than...
Like interest rate than the VA? I mean, what's the diff?
Yeah, no. When you're putting 20%, 25%
you're
down,
good.
Yeah, you're going to get really competitive rates.
So yeah, maybe you might lose the entitlement, but you're going to be good on your loan.
Mm-hmm.
Yeah.
Yep. And especially if that veteran doesn't have a funding fee, like if they have a funding fee associated to their loan, it would actually be, in my opinion, more attractive to go with a 20% down in that situation with a conventional loan.
Dude, what kind of wizardry are we missing here that you might share with the rest of us?
Okay, so in regards to assumable loans, I would, if I was the buyer, like I said, I would be looking for homes that have a higher loan, a big loan on it, and the sales price isn't too far away, because the farther away that the sales price is, the bigger the gap, the more of the down
the
payment.
And
So
Yeah,
really,
or the
the
second
second.
mortgage.
so really, the ones where everybody looks at like this house just sold 2 years ago. That's like the perfect house, you know. And
That's
the one
great,
like,
yeah.
why is this for sale again?
90-day flip.
Yeah,
No.
no, exactly. Yeah. So, no, that's really good, man. Really good.
Yeah.
Let's shift a little bit. Can we shift a little bit?
Sure.
Something that we didn't plan on covering. So with the buyer broker agreement, we just saw that the VA is allowing for
The buyers to pay the compensation to the agent.
yes, which was never allowed before.
Correct.
Right. So what do you see happening there? What do you see like it looking like in a normal VA transaction for because typically veterans have the reason why they have the VA loan is like it's 0% down.
Mm-hmm.
So let's just assume that a veteran doesn't have that much money in this case to put
Okay.
down, and they have to pay the buyer broker fee. What do you kind of think is going to happen here in these situations? What do you think the typical transaction is going to look like for veterans?
I don't think it's going to really change too much, to be honest with you, because I mean, if you're the seller and you're selling your home, you want to sell your home, and ideally like a 60 days or less.
Yeah.
You're gonna want to pay the compensation and make sure the deal goes through smoothly, right? And to be honest, the VA buyer was always paying the compensation. It was just into the sales price of the home.
Yeah. Yeah. So it's either you're going to pull it out, either if you're not going to cooperate, then you're going to have to reduce the price of your home substantially because it's percentage versus the total dollar amount, or you pay the compensation to the buyer's agent. Yeah.
I mean, as I said, before all this happened, it was just inside the sales of the home. So the VA buyer was going in there, and they weren't paying it, out of their pocket. The seller was paying it, but they're buying the home and they're paying the note. Yeah. And if it's 100% financing, right? So.
Yeah, I think you're right. Yeah, I think that's going to be how it looks for like most of the transactions.
Yeah, probably.
Probably, I would say most of the transaction will keep it probably standard, right? And there's going to be some that are like, nope, not doing it. Yeah, and that's where it's going to be a negotiation, right, with the buyer and seller's agent, and especially when they go to do all their inspections, right? Something to kind of keep in mind.
Well, I love it. These are great ways of not letting interest rates stop you from purchasing a home.
Yeah, right. I agree. Thank you so much for being on, Harry. We always appreciate your time.
No,
okay, yeah, so we have a few personal questions just to get to know Harry better inside the life of a wizard. What is your favorite book?
I really hope
Harry
this
Potter.
sticks.
Or Mortgage Wizard. Or TV show, man. Harry Potter. Just kidding.
Favorite book? You know what? I go through seasons. I don't know if you guys do, but I go through seasons.
Oh, we all do.
Yeah, we all go through the seasons. And so I would say my favorite book right now is Your Next 5 Moves by Patrick Bet-David. It's a really good book. That's a really good book. So
do you know your next 2 or?
I don't even know the next one. That's why I'm reading my notes. So that's why I'm reading his.
Can you tell me what my next moves are?
Yeah. Well, it's relatable, especially when it comes to loans, right? Because it's a loan. When you're doing someone's mortgage, it's not as simple. Like, oh yeah, just go, do these 2 steps, and then you're because what happens in the transaction if, they lose their credit or they lose a job or income comes in differently, right? So you need to know those next couple of moves as outs or ways to maneuver the transaction to still get it closed, right? So that's why I really do like that book.
That's so cool, man. That's a great book. What are you kind of watching right now on TV? Any good binging or anything?
I really don't watch TV.
Good.
Yeah,
Those
I really
high
don't.
producers, high performers don't watch TV, man.
I don't watch. I don't have time to sit there and watch. I do like to here and there, but I'm not a big TV person. I do like YouTube and where you're learning stuff, right? So like Patrick Bet-David's YouTube channel. If you're not subscribed to it, I would check it out. He drops so much good content.
It's good always.
Oh, it's so good.
It's so good.
Okay, I love it. Who is the most influential person in your life?
I saw that question and I was just thinking it's Jeff. No.
Not allowed.
That's a tough question to me. I feel that my most influential person is it. If you say influential, that means that they say something and they make you do it pretty much, right?
I mean,
Sure, it could be.
They don't make you do it, but like,
Well,
they draw you to want to change or be a certain way, or may become a certain
you're
way.
attracted to that. Yeah, like it's like a fly to the light.
Yeah, yeah.
I'd say my wife then, because she makes me do things that
She makes you do things.
yeah, she makes you do. No,
You're a fly to the light,
yeah, you know,
dude. The wife is great.
it's who I think it honestly it's the people you surround yourself with, right? So I'm obviously around you guys a lot. I'm around Mark Frasca a lot.
Oh man,
Dude, if you haven't met Mark,
He's been on the podcast.
He's one of my
a few
top
times.
most influential people as well.
yeah, Mark is super influential, and so people like it's a collective of people. I'd say.
So good, man.
Cool. Love it.
Dude, okay, so ideal day on the Central Coast. Please include something about food. And we would love to hear what you want to do on the Central Coast.
Ideal day on the Central Coast. I really think if I'm going to enjoy that day, it's going to go probably to some type of water. So to the beach, to the lake. I mean, how many places, we have a lake and a beach within
right there,
like 15 minutes of each other, so
I don't know of any other places.
I can't think of one right now.
I can't think of any.
They've got to exist.
They do, I'm sure.
I know, I'm sure they're like, there's about 50 of
It's
them
like
in California.
100,000, you idiots.
Yeah, I know. It's like, oh, sorry. Yeah. So ideal day on Central Coast is getting up in the morning, go to go to the lake. I like the lake and go on a boat and just enjoy the outdoors, and have a beer and have some food. I mean, just relax. That's the ideal day if you're gonna be actually enjoying the sunshine with the kids, right?
I love it.
Family. That's an ideal day.
That's sick.
I'd say.
On the water.
On the water, somewhere in the water.
Okay.
Yeah. What about yourself?
Oh, that's no one's ever asked me.
Next question.
Question.
Dude, that's so good. No, I mean, I think honestly, like, I love what I do. I think Travis loves what he does. And so just pretty much every day is an ideal day. There are days that are definitely more stressful than others. And if we can get rid of that stress, that's good. But spending time with family, going out spoon trade.
Golf, probably. Surf.
You golfer.
Yeah, I'm a golfer.
Don't judge him.
Yeah, I'm not good, but I love to golf.
I can hit the ball. But
I would definitely get a sandwich or a burrito or both. If calories don't count on your perfect day.
People invite me golfing often, and then they never invite me again.
Yeah. I'd end up at Ember.
You end up crashing the cart.
They're like, oh, dude, that poor house that you just nailed from every angle.
But the reason why you nailed the house is so you could talk to the seller.
Hey, it's time to sell.
Cocktails at Nightcap.
Yeah.
Go up to Paso, maybe. I'm still in it.
He's in fantasy.
You know what's up and coming? I feel like the up and coming city is Tascadero is definitely.
Oh, dude.
Oh my gosh.
Yeah, Tascadero's rad.
Yeah, when we went up to your event up there that you had, I was like,
Wild Fields Brewery.
Yeah.
Shout out.
It's good.
So
okay.
Good. Dude, he's got from the World Beer Festival something. He got like silver on the same beer he got gold the year before. So
they're crushing
their
it.
Beer's so good.
Take it on the boat with you.
Yeah. Man, so Harry, you're the mortgage wizard with Equity Reach Mortgage Solutions.
Can you please put that on your business card?
I'm going to have to switch over my Instagram handle.
Yeah.
I think that'd be great, Mortgage Wizard.
Yeah, it's actually really good.
It's pretty cool.
Yeah.
The question, though, is how do people get in touch with you? That's what he's getting at.
Through spells.
Just like smoke signals. Harry, how do you?
Harry.
So, there's a couple ways, right? One is obviously if you reach out to Travis and Jeff, they're obviously going to direct you in my way, hopefully. You reach my cell phone, right? My cell
Which
phone,
is what?
805-459-7601. I do text on there.
You know how
you can text? You are a wizard.
What is this? Texting.
Man, it feels so awkward just handing out just blurting it out. But that's my cell phone. That's my direct cell phone. That's the easiest way to get a hold of me, honestly. Okay. And then the second way is, email harry@equityreach.com. You can always look me up. I'm on Instagram, Harry the Lone Guy. It might have to change it to Harry the Lone Wizard.
Please do.
The mortgage
guy
wizard.
is so boring.
Mortgage wizard.
The mortgage wizard. Yeah. So, but that's the probably easiest ways to get a hold of me there.
Awesome.
I love that.
Thanks, Harry. You're the man.
Thank you guys for having me on here.
Dude, it was a pleasure having you on. That was fun.
This is fun.
Cool. See you on the boat.
See you on the boat.